Okay, let's dive right in. We are going to break down a really critical shift happening in the financial world. It's all about why one of the most trusted assets on the planet, the US Treasury bond, is suddenly flashing some serious warning signals. We're calling it the 4.3% Treasury Trap. All right, I know what you're thinking. That statement, it probably goes against everything you've ever learned about investing. But the reality is, market dynamics have fundamentally changed. And look, understanding this is absolutely crucial because this isn't just some abstract theory, it's the new reality for your money. So, to really get why things are so different now, we've got to rewind a bit. Let's remember exactly why US Treasury bonds got this ironclad reputation as the ultimate safe investment in the first place. For decades, this was the absolute bedrock of conservative investing. You lend the US government your money, and in return, you get the full faith and credit of that government promising to pay you back plus interest. I mean, in theory, it's as close to risk-free as it gets, right? The government can always tax people or, as a last resort, just print more money to make you whole. And this created a very predictable dance in the markets. Whenever stocks got choppy, money would pour out of equities and rush into the perceived safety of bonds. This flood of buyers would push bond prices up, which in turn pushed interest rates down across the whole economy. It was like the financial system's built-in shock absorber. It made borrowing cheaper and basically stabilized everything. And that is the core question of our explainer today. Because lately, with all the uncertainty from trade wars and global conflicts, we're seeing the complete opposite happen. Investors are actually selling bonds. And that brings us to a fundamental, unbreakable law of finance. To really understand why selling bonds is causing so much chaos, we need to look at a simple but incredibly powerful mechanic that governs every single bond out there. Think of it like a seesaw. It's really that simple. On one end, you've got the bond's price, what you could sell it for today. And on the other end, you've got its yield. And they are just locked in this perfect inverse relationship. If one goes up, the other must go down. This isn't a theory, it's just math. For example, let's say you own a bond that pays you 3%, and suddenly the government starts selling new bonds that pay 4%. Well, who in their right mind would buy your old, lower-paying bond? Nobody. To sell it, you have to drop the price. And there it is. That's the seesaw in action. Now, here's the crucial point. Not all bonds are created equal on this seesaw. The longer you have to wait to get your money back, that's what's known as the bond's duration, the more sensitive its price is to these changes in interest rates. So, a 30-year bond is like sitting at the very, very end of the seesaw. Even a tiny push sends you flying. The 10-year Treasury is still way out there on that plank, making it super sensitive. And this just illustrates the danger perfectly. It's what the market brutally calls principal slaughter. Because of that duration risk we just talked about, a seemingly small 1% jump in the 10-year yield can wipe out roughly 10% of the bond's principal value. Just gone. To put that in perspective, a 1% yield increase effectively erases years of your interest payments from the bond's market value. Your safe asset just took a hit like a bad day in the stock market. So that begs the question, right? Why are yields rising so much in the first place? Well, it's because investors are waking up to a brand new world of risk, and they're demanding to be paid for taking on threats that, honestly, barely registered just a few years ago. This is what the big institutional investors are calling the triple premium. It's not just one thing, but a cocktail of 3 different risks that are all pushing yields higher, and because of that seesaw, pushing bond prices lower. So let's break down each one. First up, the inflation premium. Look, if your bond pays a fixed 4.3%, but inflation is chewing away 3.3% of your purchasing power, well, your real yield is only 1%. Yeah, you're still getting the 4.3%, but that money just buys less and less. Investors are now demanding higher yields up front to protect themselves from the risk that inflation in the future will be even worse, potentially wiping out their returns completely. Second, we have the term premium. This is just the price of time. In a stable, predictable world, investors don't need a lot of extra cash to lock their money up for 10 years. But in today's world, with rapid policy shifts, global instability, the risk that something crazy could happen over the next decade is way, way higher. Time itself has just gotten a lot more expensive. And that leads us straight to our third, and maybe the most important factor right now, the geopolitical premium. From conflicts in the Middle East to simmering trade tensions, the world is just a riskier place. These events aren't just headlines. They can directly cause supply shocks that reignite energy inflation. Which brings us to a very real scenario that ties all these risks together perfectly.
So this isn't just an abstract idea. Let's walk through a very plausible case study. We'll see how a single geopolitical event could set off a devastating chain reaction, leading directly to that principal slaughter we've been talking about for bondholders.
Okay, so our flashpoint begins in the Strait of Hormuz. This narrow channel is one of the most critical energy choke points on the entire planet. Any disruption here sends immediate shockwaves through the global economy. So in this scenario, a US Navy blockade basically cuts off a huge chunk of the world's oil supply. Just like that. Now, what's so powerful about this is how it connects a news headline directly to your portfolio. The conflict kicks off an immediate spike in oil prices. That energy shock then feeds directly into higher inflation across the board. So in response, central banks like the Fed, well, they have no choice. They have to hike interest rates to cool everything down. And the second they do that, bam, the bond seesaw slams down and existing bondholders face that catastrophic principal slaughter. And this brings us right back to today, right back to the dangerous illusion that might be lurking behind that very attractive 4.3% number. I mean, on the surface, after years of near-zero rates, a 4.3% yield looks fantastic. It seems safe, it seems steady and reliable. It feels like a reward for being a cautious investor, especially after being starved for any kind of yield for so long. And this is the fundamental disconnect happening right now. The difference in how you see it is what separates the average retail investor from how the huge institutions are viewing the world. Because believe me, they are reading that 4.3% very, very differently. This table just lays it all out crystal clear. The retail view sees 4.3% as a safe income stream, but the institutional view, they see it as the price of risk, a warning signal that the market is demanding to be paid for potential war-related inflation. The retail view assumes the principal is 100% safe. The institutional view sees a high probability of a double-digit loss if yields just tick up towards 5%. So the very thing that was once the stable anchor in a portfolio is now seen as the most volatile, unpredictable asset you might own. So here's the crucial takeaway. The old playbook is broken. The whole reason you owned a classic 60-40 stock and bond portfolio was that when stocks went down, bonds were supposed to go up and cushion the blow. But in this new environment with high inflation and geopolitical shocks, they can both fall at the exact same time. The hedge is gone. And that right there is the billion-dollar question that every single investor has to be asking themselves right now. The game has changed, the rules are different, and the assumptions that worked for the last 40 years, they may not work for the next 10. Redefining what safe truly means, that's the new challenge for all of us.